Welcome back to Insight. Hi, I'm Hammer, and I would like to welcome back to the show Heather Foster. Heather, it's so nice to see you today.
It's always good to be here.
We are here on it's a beautiful day outdoors.
It's gorgeous outside.
And we need to talk about generating ourselves some income, right?
I think so, because I think a lot of people, when the markets start to go down like they are right now, they get concerned. Am I going to be okay, or am I not going to be okay? Mm-hmm. If you are in investments that are generating a harvest, an income, then you have to think of it this way. If it's generating enough income through dividends and interest, bond yields, fixed investment yields, and again, stocks that are generating dividend, preferred stocks, then the yield or the harvest can go into a cash pot. The cash pot can pay you out. When you're living off of your investments that way, you're never having to go in and sell shares of stock to fund your own income. All you're doing is living off of a harvest. And so I think a lot of people misunderstand that investments, if they're growth oriented, meaning that they are in companies that are not producing dividend income or income off of them, then you would have to go in and sell shares of stock to give yourself an income, correct? Then you're selling at different parts of the market, highs and lows. So somebody that's all stock oriented, that their investments are not generating income, they have to sell things to give themselves income. So the concern there is, you're right, if the markets go down and you're having to sell shares of stock, you're selling them at losses now, then that can devastate a financial plan. But if you invested in the first place into things that are generating a harvest, and you're able to live off that harvest, then the market fluctuations will not really affect you long term. Yes, on your statement, you might see a negative number on there, but you didn't sell any shares of your stock, meaning you're allowing them to stay in the market to recover, to continue to grow and go about their way. The best laid plans that I've ever laid out, or that most people that I meet that have a lot of assets and they continue to accumulate and they're able to leave a lot of money to the next generation, are in investments that are producing this income flow to them. So on the opposite side though, people again who are heavy in the market that are trying to just grow their money is not geared towards investments that produce income. What you have to do is every time you make some profit, you need to scrape your profit off the table and put it back into another pot so that you can live off of that. If you don't do it that way, then that's the people that are going to get devastated in a recession, because they actually have to sell shares of their stock in a downward market to live off of it.
So with those kind of investments, are the risk higher for us, or does that depend on the what you're going after itself?
Typically, the growth investments actually technically have typically more risk to them, because what a growth company is doing is they're saying, hey, we're not going to pay out any dividends. We're instead going to reinvest all of our profits as a company back into ourselves. So typically, the beta or the risk of a stock that's more growth oriented is typically more risky than a company that is paying out a dividend to their shareholders. But you have to look at obviously every company, and large cap, mid cap, small cap. But the dividend holders tend to do very well when the markets are volatile. People like to invest into a company that turns around and invests back into themselves. So them giving them money is generating that income, so they're not having to sell their stocks during market deviation. So if you are not in a portfolio that you are certain that the income that you're pulling out of it is actually out of a harvest, instead you or your current advisor are selling things, right, to give you, hey, I need $10,000 as a supplemental income a year, or 20, or 30, or 40. If you don't know where that income is coming from, you need to get a second opinion and do a deeper dive. Because if you're not living off of a harvest, you're always going to be in a position to sell. And selling in up markets, that works out great. Selling in down markets, that doesn't work out so well.
Once again, we need people like you to help us through that, so we're not just risky trying to pull things out and making things work. It's about balance, right?
You should absolutely be balanced, well diversified. And again, most people don't want to be all in stocks, so then that's where that bond, those fixed annuities, short-term fixed annuities, CDs, the interest rates on those, because we're finally seeing 3 and 4 and 5% yields again for the first time in a long time, you can get that income off of those.
Thank you so much, Heather. Thank you again for joining us. And if you have any financial questions, call the number on your screen for a complimentary consultation today.